Welcome to 20 Minutes of Clarity.
I'm your host, as always, Jason Noble, and with me today is the knowledgeable Andy Merchant. Today, we're going to focus on a crucial aspect of retirement planning, which is income replacement. We're going to explore this into more detail because we've already covered pensions and Social Security in an earlier conversation. If you haven't listened to that, go back and listen to it. It's the one right before this one. But now we're going to do a deeper dive into what this is really looking like. And the reason why is because retirement should be a time of relaxation and enjoyment, not financial stress. That's why it's so important that we provide you this information so you can make better informed financial decisions. Andy, it's always great seeing you. A good way to kick off a conversation is seeing that smiley face of yours. Anyone who wants to engage us in conversation, just go to clearpicturefinancial.com, scroll down, enter your information, and go ahead and we'll start the process there. But Andy, income replacement strategies is in retirement. Now, if you want to touch on Social Security or pensions, we can, but I want to move the conversation forward. What are some of the things that you're thinking of as you're building out this approach for your clients that are nearing and going into retirement?
Well, the biggest solve that we have as retirement planning professionals for our clients is how do we get them to and through retirement without any volatility or risk to their cash flow. And oftentimes a lot of it goes into it, and part of our challenge, as advisors, is that our clients have different timing. A lot of ones that plan ahead, those are a little bit easier for us, right? Because we have time on our side. We have a little bit of time set to kind of get mindset focused within the client on the product and the strategy. But then others are like, hey, I had a plan. I'm done. I'm ready, and then we gotta work through it. So it really comes down to how do we help them produce as much cash flow as we possibly can with as little risk as possible. And I know you and I reference a lot of really good research material from some of our advisory groups that we're part of, and I think today's conversation, is going to be very focused on data. I'm hoping that we can make it more of a case study so that people have real actionable items to add in protected income to the retirement. So that's the goal of today, is to be action packed, but there's gonna be a lot of information. So buckle up.
Yeah, and when I was going through the retirement income certified professional designation, there was a lot of things that came into retirement, replacement ratios. So what does that really look into? So I always like to define what it is. So it's like, okay, if you're making before you're retired, let's say $100,000, there's a good chance you won't need to replace 100% of that, right? So that you wouldn't need like 100,000 in retirement. You would need like $86,000. Now, my clients that, and this was like through the studies, right? And like individuals that are making like 50,000 before they retire. Well, again, they won't need to get 50,000 throughout retirement, but they would need to get like 94% of that, right? Let's just say 45,000 to make my life a little bit easier, right? And then for those who had higher income, up to 300 grand, it wasn't that they needed 300 grand in retirement. No, they would need something around like 70% to replace that 300,000, right? And so it was interesting to see that the replacement rate, based off of their economic status, right, as far as their pre-retirement income, of how that went down over time to really over not just time, but over like the amount of assets beforehand. And so there's a lot that goes into why that is, but the major thing is like taxes come into place on that. But then also, if you're making, let's just do some logic here. If you're making $30,000 a year, you're most likely paycheck to paycheck. So when you get into retirement, you're going to need around the same amount of income as you did before. Now, if you're making 300,000, wonderful. That's absolutely incredible. But you're most likely not paycheck to paycheck. And so you're paying a lot in taxes, but then also you're putting money into savings accounts and things of that nature. You're not spending it. So when you go into retirement, that's why your replacement ratio will be lower than someone who's making like 30,000. Any comments or insight to why, I want to kick off with that and like how you see that within your clients as well?
Well, I think it's the meat of our conversation today. This conversation we're going to share today and hopefully have a good discussion around is really centered around doesn't matter if you're making if you need to replace $50,000 of working income or if you need to replace $300,000 of income. There's a solution for it, but I think the reminder bullet on everything is replacement income is an important number that we start with when we meet with clients on retirement income. We also go back to our past episode where we dove into portfolio reliance rate, and our goal is to reduce that. And I'll hit on a point with that here in a second. And then, of course, we always try to maximize as much of your already in force or owed to you, we'll call it, strategies of Social Security and or private pensions if you already have them. So that's where I'd start. And I think it's we're going to download and upload, or I should say, um, a report or this graph, this visual image that you can get in the show notes or on clearpicturefinancial.com. You can see everything we talk about there. But this graph will kind of help you, our listeners and viewers today, kind of get the right mindset of, okay, what do I need to do and how I'm going to do it? So that's the only thing I would really add to this point is maybe check that download out as you're listening to this.
So Andy, going into the conversation, you may need for like a certain percentage, a certain amount required from private or employer sources, right, to be able to provide that replacement income. And that could really range roughly between 40 to like 55%.
Mm-hmm.
So if you're going to get like only a certain amount from Social Security, which comes in and covers a certain percentage, what else do you need from other sources? And so you could get so much from like the private markets and some portfolio income, but then what are you going to do on the private sources or the employer sources? We already talked about the employer sources on a pension, but let's talk about like a self-funded pension, like through like an annuity. And something that you and I just do is we just call it what it is. So if you heard that word and you're about to click off, like continue listening because we got more to talk about on this topic.
Yeah, no, it's I've always used the word it's your personal pension, right? In the world of the annuity, it's just been marketed bad for all these years, and the reality is that it's the only way that you can partner with an insurance carrier to reduce the downside risk and or secure a guaranteed income payment, or at least contractually guaranteed. We like to use the word protected income source. And it's all about the right design. There's got to be a little cook time and not cook time. And I know we're going to talk about some samples here in a bit that are going to really drive some numbers that are going to be the real why statement into this. But first step, as Jason said, don't click off, change your mindset. And just at the end of the day, if we could show you a way, or if you could see a way that says, oh, wow, I can reduce all of my income volatility by adding this strategy. And oh, by the way, the best part is I don't have to come to the table with nearly as much saved capital. Like, yeah, I'm in, right? So that's the question we're going to ask you today is be open-minded. We got some really clever strategies out there. This is going to be the only one we probably dive a little bit more product strategy into than any one of our other podcasts, but it is such a product-driven conversation, and it's a way to buy future income protection. And we might hit a few of the rules, but this is more about strategy, not product specific.
Yeah, and I'll just start with saying like some of the reasons why people wouldn't be interested in this is due to the complexity that are involved within this financial product. So you really have to understand the features, the benefits, but also the potential drawbacks required with thorough research and with professional advice, and making sure that the advisor you're speaking with is a fiduciary and are looking at this as a part of the overall picture, not just this is going to be a save all, one all, fits all kind of solution. Not only that, there could be liquidity issues. There's times where you may not be able to withdraw over certain percentages. And you could withdraw money before then, before you turn it into like a guaranteed income stream. You could withdraw money before that, but that may lower what they guarantee. So there's certain levers that you could pull and push, and buttons you could push to that could modify what's really going on within this the product. So making sure that when you're being like someone starts walking you through this, they're showing you not just the benefits of the things that you will receive, but also the issues that you have to be aware of. And then how do you offset those issues or mitigate those issues by having other assets doing something else, right? And then also be aware of the tax withdrawals. Like if you're going to do this inside of like a joint brokerage account and you start doing withdrawals on it, you may have to wait over certain time frames before you withdraw that money, or you could be subject to a 10% penalty if it's in a qualified account. But like non-qualified, how they do the distribution could be at not just, it's not at capital gains, but it will be on ordinary income. So, right, all these different factors come into play. And this needs to be shown with you, not just with like an illustration, but also into your financial plan. If they can't show you what it looks like within your overall comprehensive financial plan, they're just showing you a glossy, what I heard before was a four-page colored pamphlet is what they say in the military, right? And for those that are in the military, I apologize, I butchered it. But what I'm getting at is like if they're just showing you that pamphlet, they're not showing you how everything else fits in, you're not working with a qualified professional. I can tell you that right now. So Andy, let's go into when you're designing, let's say, an annuity within a client's portfolio. What are some of the key factors that you're looking at to determine does this make sense for them to even consider?
Well, let's just dive right into a live case we're working
Okay.
on, right? I think it hits all the points there. You know, we have a client right now. Him and his wife are looking to retire. Obviously, everybody's got a little bit of a risk adverse approach, but let's just use the number. We're trying to solve for income replacement of 100,000. So going through the Clear Picture Wealth analysis that we built, that Jason and I run and our teams run, we were able to get some of the core data. And one of the main features is that the portfolio reliance rate, as you've heard in past conversations, after we've kind of solved for what their needs are with Social Security, came out to be about a 40% portfolio reliance rate, right? So as a reminder, portfolio reliance rate is after you take your income, and then you deduct out any of your protected income sources, passive income sources, and whatever's left over is what you need your portfolio to produce, right? And the higher the number, the more risk you have on market volatility. And so what we were trying to do is we always try to get most of our clients down. In this case, we wanted to get them down to 20% portfolio reliance. You know, we felt that was a comfortable number. You know, that way there's enough money in the portfolio. So what we had to figure out is how much income did we need to solve for to get that number down there? And so in this case, right, if we do the simple math, it was $20,000 that we needed to go out and find a solution that provided protected income. Well, utilizing a little bit of a window room, doesn't need all the assets, we determined that was the number. So we solved for how much premium we needed to use. And here's the really cool part, Jason, is that for this particular client, they're 66 years old. We got a little buy time, meaning we don't need to start any of the guaranteed income distributions for a couple years. And we wanted to keep some flexibility to even extend that date out. But our decision was, let's just go ahead and put a stake in the ground that we're going to start it at, 68 years old. So a couple years of retirement, figure out how that retirement income stream is needed and wanted. And by doing that, we were able to forecast that the client only needed, get this, Jason, to come up with $250,000 of their saved money. We're going to use their 401k when they retire and roll it out. We'll put it into an annuity, and it's projected that in 2 years from now, it's going to have a minimum of $22,000 of income. And it's joint income, which is the best part for both lives. So if one goes ahead of the other, then that income isn't going to be disrupted along the path. So really excited to show that, because I think it's really important to note that if Jason and I, or if I would have gone for this client and said, how much money do we need to have in your nest egg to produce that secure $20,000, that's $550,000 using the traditional 4% rule. So I felt so much better sitting down with the client saying, hey, do you have an extra $550,000 laying around that we can allocate specifically to this $20,000 income stream for the rest of your life? Or should we just go ahead and use half of that number, which was only, in this case, the client has a little over $1.2 million in savings accounts. So, I mean, a very small 30% of their saved assets go to there, and it freed up so much flexibility. So that's just one scenario of how we're using it recently, but it was all driven on portfolio reliance.
I have So I'll talk about a case study of someone I was working with recently where they were retiring and they had a pension that was going to be due, and they could either do the lump sum or they could take the regular income off of the pension. Now, taking a look at their financial plan, what if we took that lump sum and we put that into an annuity and waited a few years and then took the income stream off of it? Instead of them getting, it was around $60,000 from their pension per year. By doing this, they were going to get closer to $84,000 a year from the annuity. So they get more, and not only was it that, but we had when you took a look at MAPS 21 regulations inside of pensions, it changed how they were calculating their interest rate. They were showing that they were underfunded. The pension was underfunded. And then with MAPS 21, they were appropriately funded. So that created like an area of caution there. Then we go to a company, an insurance company that is AAA rated, been around for over 100 years. They felt more comfortable with the financial solvency of the insurance company than they did of their own pension. Now, what that was able to do with that extra income is lower their portfolio reliance ratio. So now the portfolio reliance rate, once we have that income kicking off, it's going to drop down to 1%, which means what we have left over in the public market, it could go 100% stock, 100% cash. They run the risk of like not running out of money with a 1% withdrawal rate.
Yeah.
Right. And so what I like about this is we were able to take their pension, get more bang for the buck by doing that, have the rest of the accounts supplement to the time that we turn on the income spigot. But then in the meantime, when we turn on an income spigot, it's going to totally change what we do within the rest of the accounts. Now, there's always like considerations that come into this, right? And one of those considerations is like in taxes, like when you have to pay taxes on it. In both of those samples that we described, I'm assuming that you use qualified money, right, Andy? Like it was retirement money?
That's the ideal target.
It was traditional IRA.
Yeah.
So in both of our cases, it was both IRAs. So that means our clients have to pay taxes on the money that they get off of it. And so one of the things that I described to the client was like, hey, we're lowering like the chances of you having major market volatility to rely on income for the rest of your life because we're passing on that risk to the insurance. We're transferring that risk, burden that carries over to the insurance company. But here's the deal. Uncle Sam's going to come in and say, hey, I'm your partner on this, right? And they're going to take their money. Yeah. We're guaranteeing that to be the case. So here's what we're going to do with the rest of your funds, right? To see how we could offset tax liabilities on required minimum distributions to QCDs and other things that come into play. So we were like, okay, we have this risk. We offset this risk, but then we carry on this burden now with the taxes. Here's what we have to then do to account for this. Do you see how all these things are connected? Even though we have a podcast on different topics every single time, under a clear picture analysis, under the wealth program that we have created, it's all connected. And so you may take a snippet from this one or another one, but then if you're going to do this on your own, you got to figure out how do you connect it yourself. Or what you do is you go to Clear Picture Financial, you scroll down, you enter in your information, then you work with a qualified professional to see how all this is connected for you. And we do it with you. Andy, as we wrap up our conversation today, what other things would you want people to consider when it comes to what we were discussing about with the retirement replacement income?
Yeah, no, you hit a lot of really good things. I mean, I really just would probably go to a closeout more of, hey, if you're out there and you're nearing or thinking about retirement or even in retirement, you're usually not too late to consider adding a protected income stream to your overall strategy. So if you have any concern, if your portfolio reliance, if you feel like you're relying so much on your portfolio to produce income, you got to give us a call, right? That's what our analysis is there for. If you're planning for retirement and don't know how much you're going to have to depend or what that savings amount is, you got to give us a call. We're here to help on answer those questions. But I love your point there, Jason, too. If you have a private pension right now, there are so many pitfalls and downsides to a private pension that an annuity could come in and help you with. But here's the problem is if you've already elected it, you can't change it, right? And so, you might as well have all that information, to Jason's point, in front of you so that you can make the most informed decision. And, we're just here to help. I mean, we built this program for value add. We built this podcast for value add. So all of our listeners that have reached out, we hear you, we're listening to you, and we appreciate you telling us that. But for those that haven't engaged yet, I'm telling you right now, go to clearpicturefinancial.com. You can even email us at clearpicture@pciawealth.com, and Jason or I's team will get back to you and schedule that complimentary core value conversation and see if we can help. But this is a very important subject, so I hope everybody listened to enjoyed a little bit of tidbits on how to get some protected income stream.
Thank you, Andy. It's always a pleasure talking with you, my friend.
All right, till next time.